Good morning, sir. Good morning, classmate. We are the group 9 and we discuss about chapter 26, the market for residential mortgage-backed securities. The learning objectives of this chapter are the development of the current residential mortgage market and the role of public and private conduits, the process of securitizing residential loans, the different sectors in the residential mortgage-backed securities market, the different types of agencies of mortgage-backed securities and their investment characteristics, what is meant by prepayment risk and how prepayments are measured. Next slide. How tranches will different prepayment risks are created in a collateralized mortgage obligation, the two sectors of non-agency mortgage-backed securities market, how credit risk is redistributed in a non-agency collateralized mortgage obligation, the different credit enhancement mechanisms for a non-agency collateralized, the mortgage obligation, the subprime crisis in the summer of 2007. Next slide, please. The development of the secondary mortgage market. It is where asset securitization involves the pooling of mortgages and issuing securities backed by the cash flows of these mortgages pools. At the most simple level, this can be structured as pass-through securities where principal and interest payment are passed through to security investors each month. For example, a thrift originates mortgages and sells them to an investment banker or agency. Next slide is the banker then creates a security backed by that pool. As a consequence, the thrift has shifted the credit risk to the banker or the investor, or more likely an insurer or a guarantor, having received cash for the mortgages, but it no longer funds them. Next is more likely it will only continue to service these mortgages for a fee. Next slide, please. The foundation of the mortgage market. The origins of the secondary mortgage market can be traced back to the Great Depression and the legislation that followed. The Federal Housing Administration or FHA addressed the problems with balloon mortgages and reduced credit risk for investors by offering insurance against mortgages defaults. So, securitization of mortgage loans forms the basis of the secondary mortgage market. The development could not have been accomplished without the support from various agencies. First agencies are the FHA or the Federal National Mortgage Association, or commonly known as Fannie Mae, and the VA, or a mortgage offered through U.S. Department of Veterans Affairs program. It is where it covers the amount between the loan amount and the value of the underlying property. Next slide is the agencies such as FNMA or the Federal National Mortgage Association, or the FHLMC or the Federal Home Loan Mortgage Corporation. This agency purchased conventional and agency-insured mortgages from thrifts and other originators, thereby providing them with liquidity. Third is the Government National Mortgage Association or Ginnie Mae, guarantees timely payment on pass-through mortgages-backed securities. Next slide is Ginnie Mae or the Government National Mortgage Association was able to support development of the secondary market by guaranteeing securities issued by private entities that pool mortgages together and then use these mortgages as collateral for the security sold. Freddie Mac and Fannie Mae purchased mortgages, pooled these mortgages, and then insured these securities using the pool of mortgages as collateral. Next slide is the loans that satisfy the underwriting standard of the agency are used to create the residential mortgages-backed securities that are referred to as agency MBS or mortgage-backed security. Securities backed by other loans are non-agency mortgage-backed security, which is classified into private label mortgage-backed security, where prime loans are the collateral, and subprime mortgage-backed security, where subprime loans are the collateral. Next is such securities are created when holders of mortgages form a pool of mortgages and sell shares or participation of certificates in that pool. Payments of principal and interest from the pool are in fact passed through the ultimate investor. Risk-averse investors prefer investing in a fraction of a pool to investing in an individual mortgage. Next reporter, please.
Agency pass-through securities. Cash flow characteristics. The cash flow of a mortgage pass-through security depends on the cash flow of the underlying mortgages. The cash flow consists of monthly mortgage payments representing interest, the scheduled repayment of principal, and any prepayments. So before proceeding, let's define a mortgage pass-through security. A pass-through security is a pool of fixed income securities backed by a package of assets. So a servicing intermediary collects the monthly payments from issuers and after deducting a fee, remits or passes them through to the holders of the pass-through security. So with appropriate credit enhancements and standardization, a mortgage pass-through security is also more liquid than an individual mortgage. Payments are made to investors on a monthly basis, corresponding with the standard payment schedule for that repayment. The payments include a portion of the accrued interest on the unpaid principal and another portion that goes toward the principal itself. The next one is the issuers of mortgage pass-through securities. So agency pass-through securities are issued by the Government National Mortgage Association, Ginnie Mae, Fannie Mae, and Freddie Mae. These three entities were created by Congress to increase the supply of capital of the residential mortgage market and to provide support for an active secondary market. Ginnie Mae is a federal-related institution because it is part of the Department of Housing and Urban Development. So the security guaranteed by Ginnie Mae is actually called mortgage-backed security or MBS. So the most common type of pass-through is a mortgage-backed security or MBS, in which a homeowner's payment passes from the original bank through a government agency or investment bank before reaching investors. So these types of pass-throughs derive their value from unpaid mortgages, in which the owner of the security receives payments based on a partial claim to the payments because being made by the various debtors. So the first MBS was issued in 1968. Although Ginnie Mae provides the guarantee, it is not the issuer. So when it guarantees securities issued by approval lenders, Ginnie Mae permits these lenders to convert illiquid individual loans into liquid securities backed by the U.S. government. So next is Fannie Mae and Freddie Mae are government-sponsored enterprises. Both of them are in fact shareholder-owned corporations chartered by Congress to fulfill a public mission. So the mission of these two GSEs is to support the liquidity and stability of the mortgage market. So they accomplish this by number 1, buying and selling mortgages. 2 is creating passing through securities and guaranteeing them. And lastly, buying MBS. So the mortgages purchased and held as investments by Fannie Mae and Freddie Mae are held in a portfolio referred to as the retained portfolio. So the pass-through securities issued by Fannie Mae are referred to as mortgage-backed securities, while Freddie Mae uses the term participation certificate or PC to describe its pass-through security. So the next one is the prepayment risk associated with pass-through securities. So an investor who owns pass-through securities does not know what the cash flow will be because the cash flow depends on prepayments. So this risk associated with prepayments is called prepayment risk. So prepayment risk is the risk involved with the premature return of principal on a fixed income security. So when prepayment occurs, investors must reinvest at current market interest rates, which are usually substantially lower. So prepayment risk mostly affects corporate bonds and mortgage-backed securities. The next one is estimating the cash flow from a pass-through requires making assumption about future prepayments. So two conventions have been used as a benchmark for prepayment risk. The first one is the conditional prepayment rate or CPR, and the second one is the Public Securities Association or PSA prepayment benchmark. So the conditional prepayment rate assumes that some fraction of the remaining principal in the pool is prepared each year for the remaining term of the mortgage. The Public Securities Association prepayment benchmark is expressed as a monthly series of annual prepayment risk rates. An investor in a mortgage pass-through security is exposed to prepayment risk, which can be decomposed into two types of risk, namely contraction risk and extension risk. Contraction risk is a type of risk faced by holders of fixed income securities. It refers to the risk that a borrower will repay their debt ahead of schedule. This type of risk increases as interest rates decline. This is because declining interest rates might incentivize borrowers to prepay some or all of their outstanding debts in order to refinance at lower interest rates. The next one is the extension risk. Extension risk is the possibility that borrowers will defer prepayments due to market conditions. Extension risk is generally a concern in secondary market, structured credit product investments. For instance, rising interest rates might discourage homeowners from refinancing their mortgages, which reduces prepayment flows. The only way to project a cash flow is to make some assumption about the prepayment rate over the life of the underlying mortgage pool. So the prepayment rate assumed is called the prepayment speed or simply speed. So the conditional prepayment rate or CPR assumes that some fraction of the remaining principal in the pool is prepared each year for the remaining term of the mortgage. So the prepayment rate assumed for a pool is based on the characteristics of the pool and the current and the expected future economic environment. The CPR is an annual prepayment rate. So the next one, a single monthly mortality rate or SMM of W% means that approximately W% of the remaining mortgage balance at the beginning of the month, so less the scheduled principal payment, will prepay that month. That is, prepayment for month E is equal to SMM or single monthly mortality rate times beginning mortgage balance for the month minus scheduled principal payment for the month. So next is the Public Security Association PSA prepayment benchmark is expressed as a series of monthly prepayment rates. So it's also referred to as a prepayment model, suggesting that it can be used to estimate prepayment rates. The PSA benchmark assumes that the prepayment rates are low for newly originated mortgages and then
Next slide. The stated maturity of a mortgage pass-through security is an inappropriate measure of the security's life because of prepayments. Instead, market participants commonly use the security's average life. The average life of a mortgage-backed security is the average time to receipt of principal payments, weighted by the amount of principal expected. The average life of a pass-through depends on the PSA prepayment assumption. Next slide. Here we have the average life expressed in a mathematical formula where T is the number of months. Next slide. Moving on, we have the agency collateralized mortgage obligations. Under a standard MBS, investors share proportionally in prepayments. When the cash flows of pools of mortgage pass-through securities are redistributed to different bond classes, the resulting securities are called agency collateralized mortgage obligations. A CMO provides for several classes or tranches of bondholders with sequential repayments of principal. When each class of bond would be retired sequentially, it is called a sequential pay CMO. Next slide. Furthermore, in many sequential pay CMO structures, at least one tranche does not receive the current interest. Instead, the interest for that tranche would accrue and be added to the principal balance. Such a bond class is commonly referred to as an accrual tranche, or a Z-bond. Another type of CMO is the planned amortization class, or PAC bonds. Next class. This type of security provides a greater certainty of cash flows due to specified retirement schedules built into the issue. In 1987, CMO issuers began issuing bonds with the characteristic that if prepayments are within a specified range based on the PSA benchmark, then the cash flows pattern is known. Next slide. The greater predictability of the cash flows for these classes of bonds occurs because there is a principal payment schedule that must be satisfied. Moreover, the greater certainty of the cash flow for the PAC bonds comes at the expense of the non-PAC classes, called the support or companion bonds. Next slide. Moving on, another example of derivative mortgage securities are the stripped mortgage-backed securities. Stripped mortgage-backed securities, if properly used, provide a means by which investors can hedge prepayment risk. So a stripped mortgage-backed security is created by altering the distribution of the cash flow from underlying mortgages. Instead of distributing cash flow on a pro rata basis as in the case of a pass-through, or a priority basis as in the case of a CMO, there is an unequal distribution of interest and principal. Next slide. By doing so, some of the securities created will have a price-yield relationship that is different from the price-yield relationship of the underlying mortgage pool, wherein the interest-only class receives no principal payments. These IO and PO securities are referred to as mortgage strips. Both POs and IOs exhibit substantial price volatility when mortgage rates change. Next slide. So an IO's price moves in the same direction as the change in interest rates. The first generations of stripped mortgage-backed securities were partially stripped. In early 1987, stripped mortgage-backed securities began to be issued, in which all of the interest is allocated to one class, called the interest-only or IO class, and the entire principal to the other class called the principal-only or PO class.
Non-agency MBS. The structure that is used for a non-agency MBS is the CMO structure, which is referred to as the non-agency CMO. So the credit support is needed to absorb the expected losses from the underlying loan pool due to defaults. So this additional credit support is referred to as the credit enhancement. So there are four forms of a credit enhancement: the senior subordinate structure, the excess spread, over-collateralization, and monoline insurance. In a senior subordinate structure, there are two general categories of tranche: the senior tranche and the subordinate tranche. So a senior tranche is the highest tranche of a security, which means it is the one less risky. And the subordinate tranche are those under the senior tranche. So for the excess spread, it is known as the difference between the interest rate received on the underlying collateral and the coupon on the issued security. So it is typically one of the first defenses against loss. So even if some of the underlying loan payments are late or default, the coupon payment can still be made. So in the process of turboing, excess spread is applied to outstanding classes as principals. Next is the over-collateralization. So over-collateralization is commonly used form of a credit enhancement. So with this support structure, the face value of the underlying loan portfolio is larger than the security it backs. Thus, the security is over-collateralized. And lastly, the monoline insurance. Monoline are insurance company that guarantees the timely repayments of bond principals, and the interest in exchange for insurance premium. Subprime mortgage-backed security meltdown. In summer of 2007, there was a crisis in the subprime MBS markets, and these crises led to a credit and liquidity crisis that had a rippling impact on other sectors of the credit market and the equity market through 2008. So this episode was referred to as the subprime meltdown. So some market observers saw it as an inevitable bursting of the housing bubble that had characterized the housing markets in prior years. Others viewed it as a product of the unsavory practices by mortgage lenders who deceived subprime borrowers into purchasing homes that they could not afford. Moreover, specific mortgage designs such as the hybrid interest-only rate loans, which made it more possible for subprime borrowers to obtain a loan that could not have expected to cause financial difficulties in the future when loan rates were adjusted upward in the case of a hybrid loan or a higher mortgage payments after the lockout period in the case of the interest-only loan. Of course, mortgage lenders blame borrowers for misleading them. Another contingent laid the blame at the feet of the Wall Street bankers who packaged subprime loans into bonds and sold them to investors and the rating agencies that gave these bonds investment-grade ratings. So whatever the precise cause, it's hard to deny that the securitization or the financial framework that allowed Wall Street to package these loans into RMBS is of enormous benefit to the economy. Securitization has increased the supply of credit to homeowners and reduced the cost of borrowing. It also spread the risk among a larger pool of investors rather than concentrating in a small group of banks and thrift and make credit available to a wider group of borrowers. While it can be argued that not all those who were shut out from the market prior to securitization were in fact weak borrowers, there is no question that in the case for securitization of subprime loans, that the low credit standard of lenders was a major reason for the problem. However, that is an attack on the underwriting standard for the mortgage sector and not a reason for attacking securitization in general. Securitization is an important and legitimate way for financial market to function more efficiently today than in the past.
So here is the summary of our discussion. The residential mortgage-backed securities market is divided into two sectors: agency mortgage-backed securities and non-agency. So MBS issued by Ginnie Mae, Fannie Mae, and Freddie Mae are included in the agency MBS sector. Agency MBS include pass-through securities, collateralized mortgage obligations, and strip MBS.
Collateralized mortgage obligation tranches are created to meet the different needs of institutional investors. Like a collateralized mortgage obligation, a strip mortgage-backed security is created from a pass-through security. The purpose of creating a strip mortgage-backed security is to provide an instrument that can be used to control the risk of a portfolio of mortgage-related securities. The non-agency mortgage-backed security is divided into private label mortgage-backed security market and subprime mortgage-backed security market. Non-agency mortgage-backed security required that credit enhancement be provided to protect against losses from the underlying pool of loans. Last is the mechanisms for credit enhancement include senior subordinate structures, excess spread, over-collateralization, and monoline insurance. That's all, sir. Thank you and have a nice day.